Hi everybody, this is Dave Van Knapp, and I'm back with another great video from the Dividends and Income channel. This is my first video about my dividend growth portfolio. The DGP, as I call it, is my ultimate illustration of what dividend growth investing is all about. If you like the content in this video, please click the thumb up and subscribe to the channel, and also push the notification button so that you get an alert whenever the channel publishes a new video. Thank you. Here is some fundamental information about the portfolio. It's been in existence for almost 13 years. I started it in June of 2008. At the beginning, I put about $47,000 into it. The current value of the portfolio is around $154,000. It holds 28 stocks. Its current yield, namely the yield that you would get if you replicated the portfolio today, is 3.3%. But the yield on cost to me, which is the yield based on how much I spent to create the portfolio back in 2008, is at 10.9%. I know that you all want to know what stocks are in the portfolio, so I'm going to display them right now, but just for a few seconds. Don't worry about trying to absorb the information now. We'll come back to them later on. At the end of the video, we'll put the portfolio back up on the screen, and you can freeze it or pause the video right there if you want to study the stocks. Before we get to the stocks, I want you to understand four things about the dividend growth portfolio. The first thing I want you to know about the portfolio is that no new capital has ever been added to it. Starting with the approximately $47,000 in 2008, I've never added another dime to the portfolio from the outside since I created it. I chose that path deliberately to make it a good demonstration of the dividend growth strategy itself. None of the numbers in the portfolio are skewed or inflated by the fact that I've been adding money along the way. So all the results in the portfolio are the result of the original portfolio plus my management of the portfolio since I first built it in 2008. I know that's not the way most of us invest in real life. We put money into our investments every week or every month or whatever the length of time is. So we're building the portfolio from the outside at the same time that the portfolio is doing its thing on the inside. But not adding new money to this particular portfolio as a demonstration has become a great way to isolate the effects of just the strategy itself and focus on the numbers that result from the original creation of and the management of the portfolio since then without any new money coming in. The portfolio is now 12 years and 8 months old. Because no new money has been added to it since I created it, all the growth in the portfolio in both its total value and in the dividend stream is organic, meaning that it came from within the portfolio itself. As you saw in the earlier slide, the portfolio's value has increased from about $47,000 to about $154,000 now, all by itself, so to speak, other than my management of it. That increase in value up to $154,000 makes the portfolio itself a three-bagger. Okay, the second thing that I want you all to know about the portfolio is that the dividend stream increases relentlessly. This is my favorite chart for the dividend growth portfolio. It shows how the dividend stream has increased year to year without fail from year to year. Right now, the portfolio is collecting dividends at a speed of more than $5,000 per year. That's equal to 10.9% of the original money that I spent creating the portfolio, and that number is called yield on cost. So the yield on cost of the portfolio right now is 10.9%. This graph shows the growth rate of the dividend stream from 2009, which is the first full year of the portfolio, to the end of 2020, which is the last full year of the portfolio. The dividend stream grew at the rate of 10.6% per year. That's a cumulative annual growth rate, or CAGR, as shown on the slide. The relentless increases in income for the life of the portfolio are the result of three things. Number one, the companies raise their dividends every year. I select them for that quality. Number two, I reinvest the dividends, which brings compounding into effect. And number three, I've made over the years occasional improvements to the portfolio, swapping out some stocks for others. Okay, let's move on to the third thing that I want you to know about the portfolio, which is how it works. Dividend growth investing is a particular strategy for investing in the stock market. We all know that stock investing can focus on growth stocks, value stocks. You can track an index. You can trade rapidly. There are literally infinite number of ways to invest in stocks. The dividend growth strategy focuses on a single way, or I should say a range of ways that all have a commonality to them. And the commonality is building a growing income stream over time. This slide shows you the top of the first page of my portfolio's business plan. And the arrow points to the primary goal of this portfolio, which is to build a reliable, steadily increasing stream of dividends over many years that can eventually be used as income for retirement. When you are investing, you need to think about what you're trying to accomplish by investing. We're all different people, different ages, different stages of life, and therefore we all have different goals and objectives. Therefore, it stands to reason that we would all invest in slightly different ways tailored to our own needs. I preach and beg you to run your investing like a business. And by that, I mean the following. Know your goals, have a plan and execute it. Trust your process and be unemotional. You'll make better decisions if you don't let emotions play into how you invest, what you choose to invest in, and so on. Now, if you run your investing as a business, then by definition, it has a business model. Here is the dividend growth investing business model. To read this, we'll just start at the top and go around the circle. Identify means to identify what you're going to invest in. In my case, that is dividend growth stocks. That's what I exclusively invest in. Analyze means to look in some depth at each company and determine how and whether and how well it will help you build your dividend growth portfolio. In other words, how will it help you meet your needs? Buy and own. Dividend growth investing, at least the way I practice it, is not a rapid trading strategy. It's quite the opposite. The idea is to buy companies that are of high quality, that you have a great deal of confidence in, who look like they're going to fulfill your needs for a long time, and then to hold them and let them do their thing. The main thing being to send you dividends 4 times a year and to increase their dividends once every year. Moving around the circle, it says manage. I've referred several times to portfolio management that I've done with this portfolio. Dividend growth investing, even though it tends towards the buy and hold end of the spectrum as opposed to the heavy trading end of the spectrum, is not a passive strategy in the sense that you buy things and just forget about them. Again, this is how I do it. I call it buy and monitor. So I'm checking things out all the time, looking for new stocks that might improve the portfolio, tracking the progress toward my goals, and so on. And occasionally I will sell an overvalued stock or a position that has grown too large for the portfolio and use the money to buy something that's, say, paying a better yield. And in ways like that, I improve the portfolio's performance over time. Moving up to the circle that says generate dollars, if you do all those things right around the circle ahead of where we are, you're going to get dividend dollars that flow into your account. Most companies pay dividends 4 times a year. So if you own just 10 companies, that means you're going to get 40 dividend payments into your account per year. That's nearly 1 a week. If you own more stocks, obviously, or if you own a few that pay monthly rather than quarterly, you'll get more payments than that. That money comes into your account as cash, and so we move on back to the top of the circle, where you use that cash that's now reinvestable money for you, and you go back to the top of the business plan. Identify stocks that'll help you, analyze them, and so on, all the way around the circle. This is what I call a virtuous circle because of the way it helps you fill your goals. If you do all of that right, this is the result. That business model results in a snowball effect on the income coming in. You saw from the earlier graph that the income, my income from this dividend growth portfolio has risen every year. And that's represented by the snowball rolling down the hill. The small snowball at the beginning represents the early years and so on down, with the size of the snowball picking up more snow as it rolls, which means more money coming into your account every year. The last thing, the fourth thing that I want you to know about the portfolio is how do you do this? The way you do it is by, number one, picking the right stocks, and number two, managing the portfolio like a business. Many people consider picking stocks to be the fun part of the business. Here are my criteria that I've used basically from the beginning, 13 years ago, to build my portfolio. Number one, I look for stocks that pay a sufficient yield. I've moved that number around over the years. Right now, I'm around 2.7%. If I find a stock paying 2.7% or above, it becomes a candidate for the portfolio. If it pays less than that, it would take some extraordinary other circumstances, such as extremely high quality or an extremely fast dividend growth rate, for me to consider it. I'm content to collect stocks that meet my requirements, and if they don't meet my requirements, even though they may be a great company, I don't consider them for purchase. My second requirement is that the stock has a history of raising its dividend every year. This is, after all, called dividend growth. So I'm looking for companies that themselves grow their dividends. My minimum requirement is 5 years. That usually requires a company that has reached a level of maturity and success that it is comfortable paying a dividend at all rather than retaining all of its money to grow itself, number one. And number two, has demonstrated its willingness to do that and its ability to do that for at least 5 years. When you begin to do research into dividend growth stocks, you discover that there are hundreds of stocks that meet that 5-year minimum requirement. You've probably all heard of the dividend aristocrats and the dividend champions that have reached 25-year streaks. But if you reach down to where you'll take something, except a stock at a 5-year streak, that adds hundreds of companies to the pool of stocks that you can choose from. I basically insist that any stock that I buy is a high quality, well-run business, and that it has a good outlook for being able to continue raising its dividend. We've already established that it's raised its dividend for several years, in some cases for decades, but we want to look forward and make sure that it has the ability to keep doing that. Possibly the biggest factor in determining high quality and well-run and ability to continue raising its dividend is the dividend safety. And we are very fortunate to have some companies now that provide information about the dividend safety. I use the service called Simply Safe Dividends, and they score dividend safety on a scale of 0 to 100. I want companies that have a score of more than 60. That comprises the top 2 tiers or 2 grades of Simply Safe Dividend scoring system, and it indicates that, in their opinion, the dividend is either safe or very safe. All of the stocks in my dividend growth portfolio had those characteristics when I selected them, as near as I could determine back in 2008. And then as I've added stocks and expanded the portfolio over the years since then. And I use those characteristic requirements right now whenever I decide whether I want to add a different company to the portfolio. I said that this last category had 2 parts to it. One was picking stocks, which I just talked about. The other is managing the portfolio. We're going to skip the managing the portfolio stuff for now. The video is getting long enough, and I want to be able to display the actual portfolio to you before we end the video. So here is my dividend growth portfolio again. I'm not going to talk about these stocks in detail today. That'll be extended over many videos that I hope to make about this portfolio. I'm going to leave the table on the screen for about 15 seconds so you can study it. And if you need more time than that, of course, just pause the video and you can check it out to your heart's content. Also, we're putting a link to the video where it's displayed online right on the screen. So you can click that link and go there. Where that will take you to is the most recent monthly update I've made to the portfolio. I update it online once a month, and you can always find it in the same place, which is where that link will take you. I'll be glad to answer your questions about this video in the comment section below. And that's a wrap for the video. I'll see you next time, and please remember to click the thumb up button if you appreciated this content, and subscribe to the Dividends and Income channel. Your subscriptions help us provide more video content. Thanks a lot, guys, and I'll see you next time.